Thank you, Mr. Chairman. Mr. Pollack, I'm sure that Mr. Hensley would be even more surprised that I also agree that the current disclosures are apparently intentionally incomprehensible. They come at closing when it's too late to do anything about it, and usually the borrower signs 10 or 15 pages in 2 or 3 minutes. Yeah. And so not surprisingly, a lot of people don't know what they've signed and what's in their loan. Where I think we part company is your apparent belief that that is enough. Better disclosure is enough and is a solution. Mr. Pollack, if someone who's been hurt in a car wreck hires a lawyer, and the insurance company tells the lawyer, we'll pay $40,000, but if your client takes 20, we'll pay you 10. If that's disclosed, if the client signs a piece of paper and says they agree to that, is that okay, or is there something wrong with that that's not fixed by disclosure?
Congressman, thanks for that question. My point was not that disclosure addresses the current situation, but that it addresses a really important element of a long-run, very much-needed fix in the way our entire mortgage finance system works.
Well, do you agree with me that the facts that I pose is a betrayal of faith, it is fraudulent, it is morally reprehensible?
I'm sorry.
It's not just. Do you agree with me that that is not okay, even if the client signs a form and says, "I agree to this"?
Signing a form is not the real point in any of this. And of course, if you have done things which are fraudulent, I agree with you that signing the form. The point is not to get you out of the commitment or to put you into a bad commitment because you signed the form. The point is to make sure that you understand what you're doing, and if you choose to take risks, which I think Americans should be able to take risks if they choose to, but they ought to know what risks they're taking.
Fair enough. A couple of years ago, I think Mr. Denham's predecessor testified here, and I showed him a rate sheet from a mortgage lender that went to brokers. And down one side of the form was a grid. Down one side of the form, it showed credit scores, and then across the top, it showed loan to value, or vice versa. And then it showed the interest rate that the borrower qualified for. But there was a footnote, and at the bottom, it said that for every point higher interest that the borrower agreed to pay, the broker would get an additional half-point payment from the lender, called a yield spread premium. I asked him about it. He first said that, well, I don't do business with that lender. And I said, well, you do business in this area. Does that happen? Is that a common practice? And then I got a fairly long non-answer that I took to mean, yes, that happens. It's a fairly common practice. I said, if you have a consumer who could have gotten a 7% loan on the very same terms, instead gets a 9% loan, but the broker gets a 1% additional yield spread premium in addition to whatever upfront commission they would have, does that strike you as something the law should allow? And he said, if that is part of the agreement between you as a customer and me, as part of my total compensation, that has been disclosed to you, it would be okay. But if this is a bonus that is outside the plan, if it is not disclosed on a good faith estimate or anything else, and I said, so if a consumer signs a piece of paper, at that point, the subcommittee chairman, Mr. Ney, interrupted me and told me my time had expired. Do you believe the law should allow that?
I believe the law should encourage competitive markets. If you go to one store, you can buy tomatoes for $1, and they might be $1.50 someplace else, and they'll be the same tomatoes. But if it says on the label $1.50, that's the price you ought to pay. We ought to have markets that make it as possible, as efficient as possible for people to understand what they're really getting into and what they're really paying. The disclosure I recommend focuses less on what the broker gets, although I know that's an issue in many people's minds, with exactly what commitments the borrower is making. I think the most important thing is, borrower, do you understand what commitments you're making and how much of your income it's going to take?
Mr. Pollack, do you think on your one-page form, instead of showing what the interest rate is and may become, it should also show what you qualified for based upon how well you've paid your bills over your lifetime. Do you think that's something that's not on your form that should be?
That would be something we could talk about, Congressman. I'd have to think about that.
The gentleman's time has again expired. And we do have to go. But I will, Mr. Park, when I come back, ask you to expand on the analogy.
To respond to one point
very quickly
on the yield spread premiums. You hit on a absolutely crucial point. The fact is, because yield spread premiums should be prevented and should be outlawed, because the fact is what they're doing is brokers are incentivized to lie to the customer, to lie to the borrower, to say they know what the par rate is, but in order for them to get paid, they've got to convince the borrower that they can only afford a much higher interest rate. You're setting brokers up to steal and to lie to borrowers, because that's the only way that they get the significant compensation out there. You hit on
we'll now have to break for the vote. It may